advice, personal recommendation, or an offer of or solicitation to buy or sell any financial instrument. So we're going to go through a few things just about investing, some do's, some do nots. I'll talk about a little, personal experience. Myself, my name is, for those that don't know, I mean, you can see for those that are on Zoom, my name is Sam North, and I've been at eToro for about 18 months now. And really my role there is education. My background before that, I was a trade mentor, risk manager at a proprietary trading firm in London. But I've come to eToro and I do webinars, events like this, in-person ones as well. We work with universities to do sessions on investing and trading and so on. But today's one is going to be talking about investing really from a sort of a top level, going through different points, but really we can dress this session up however you want with regards to questions. There's no such thing as a stupid question. I mean, I remember when I first ever got into the trading world and investing world, a lot of the sort of jargon can easily put you off. So I'm going to try and make it sort of as easy to understand as possible. And it doesn't need to be massively confusing. I think some people still make it that way. It can be a bit of a minefield, sure. I've got quite a few friends that will come to me and ask, what do I do? How do I do this? Or what does this mean? And, you just realize obviously how confusing it can be and scary, I think, to take those first steps. So that's hopefully one of the goals for today, is that, people can, have a better understanding of, if they did want to invest, how they could do it. I'm not here to promote eToro, but this is just essentially what eToro do and our vision. We've seen a massive increase over the last few years in the sort of the retail trader, the retail investor, really from the sort of onset of the pandemic. People wanted to take more control of their finances. We obviously had people staying at home during the lockdown, furlough, a little bit of extra money. You add all of that together, and people did want to start to trade or invest over the long term. So we've seen a big pickup, and our mission is really just to provide education. So yeah, our webinars and stuff and community events that we do are always free. We're never charged for anything, and if you can attend them if you're not even an eToro client. It's just education for us, and that's something I believe strongly in. And you can see how many users here: 27 million, over 100 countries, and so on. And where that sort of usership really started to pick up, sort of that back end of 2019, but really 2020 and 2021. The eToro Academy is something that I sort of head and run from an education point of view. So if after this session you wanted to learn more, or have a podcast that you wanted to listen to about a certain subject, all of that information is available on the eToro Academy. You just Google it and it will come up. But yeah, there's a podcast, a guide, video, blogs for everything, and again, completely free. You don't need to be an eToro user to do so. But I'm sure, I spoke to people last week that had heard of eToro and actually listened to the podcast, which is great. And actually we recorded one this morning, funnily enough, about retail investors and the habits that they have, and they're actually very resilient. They're clued up in the way that they want to invest for the long term. When it comes down to shorter term trading, that's when it's very hard, and the majority of traders will lose money. I think there's a statement out there where it's 90% of traders lose 90% of their funds within 90 days. It's short term. It takes a long time to master, in my opinion, over 2 years. Whereas investing is for the longer term. It requires more patience for sure, but the stats are on our side. So we'll talk a little bit about that as we go through the agenda. We'll talk about what is investing, why people should invest, what can you invest in, because of course, again, that's another minefield. And a lot of my friends might come to me and say, look, Sam, I'll pick a random number, I've got $5,000 I want to invest, but what do I invest in? And without that education, it is hard to know. We'll talk about some different types of investment analysis, the importance of diversification, and how to manage those investments. But as I said, any questions, feel free to ask. And also, if there are people that want a copy of these slides, I'm sure I can send to you, or just message me on LinkedIn or Twitter or whatever, and I can send those over. And also, even if there's questions 6 months, 1 year down the line, I'm more than happy to help where I can. But yeah, let's get into it. So what is investing? Well, investing is a sort of a longer term buy and hold strategy. So most people will probably hold for a number of years. And that's quite key, because trying to time any market is very, very hard. You get some of the smartest minds in the world at these hedge funds and investment banks that do get it wrong a lot of the time, which goes to show just how unpredictable in the short term markets can be. If we think about 2022, you know, what we've had this year, we've had the the geopolitical tensions, we've had COVID still at the beginning of the year, we've had supply chain issues, incredibly high inflation worldwide, interest rates are being raised, and that's just counting on one hand. There are more things than that. So trying to time the market throughout this year has been very tricky. But if you zoom out and think longer term, there are certainly things that are on the side of the long-term investor. I'll go through some questions that are useful to ask yourself, whether you can invest, whether you want to. But yeah, investing is very much a sort of a longer term outlook. It differs from sort of saving that money in the bank. Obviously, at the moment, historically, interest rates are still pretty low. They are going up, as I mentioned, but they're still, compared to where they were historically, quite low at the moment. So yeah, I think that's another reason why over the last few years we've seen a big rise in investing in terms of just asset classes that people can invest in. You can see a few down the bottom there. So whether it be individual stocks like your Teslas or your Apples or your Amazons, or your indices like in the UK, the FTSE 100, the top 100 companies in the UK as a global index, you can invest in that should you want to. But again, a lot of these markets this year have really struggled. So, we could have had this, should we call it this webinar, this session, January the 1st, and you could have then seen me walking down the street 10 months later and be like, God, it's been a bad year, hasn't it? For investors, and it absolutely has. But the good news is, long term, the stock market does go up. I mean, we'll talk about it in a little bit of time, but the stats that can be, I guess, calming in situations like this is that, so for example, the most invested stock market in the world, the S&P 500, so that's the top 500 companies in America, that goes up 70% of the time. So each year, 7 out of 10, it's going to finish positive. And then on average, it goes up around about 10% a year, which is good to know. That doesn't mean next year is going to be 10%. It might be down again, as it is this one. But on average, the long term, it does go up over time, which you would expect as technology improves and the companies develop and grow, and et cetera, et cetera. So yeah, at least we know that more often than not, the stock market is going to go higher, even though right now it might not seem that that is the case. But yeah, commodities, people can invest and trade in as well. So oil, gold, silver. Again, you probably need to be a little bit more clued up when it comes to sort of individual stocks and commodities. You probably need a little bit more time to understand the economic cycle or supply and demand for these different commodities. So there are, should we say, easier investments to invest in over the long term. So commodities and stocks can, vary in price, whereas the stock market in general over time is going to go higher. But yeah, let's go through why people invest. And it's probably, you probably won't be too shocked by these three responses, really. The number one is obviously about making money, building long-term wealth. That is why people will invest. I think the issue in the sort of the trading world or the investing world are these Instagram accounts or these Twitter accounts that seem to promise Lamborghini in a week. And at eToro, we're like so against that. That's what, one reason we're never going to charge £10,000 for a course when we're going to do better education and for free and make it realistic. So it's about building long-term wealth. I think that mindset of instant gains, well, of course, it could happen to that one person in 1,000, is very unlikely. So it's about that long-term process, long-term patience, and building wealth over time. Number two, again, like I said, if we had this conversation January the 1st and said, yeah, look, we're investing to beat inflation, 10 months later, you'd been like, I definitely didn't beat inflation, and maybe I should have left my money in the bank. And there would be an argument for that, except that, over time, there's a great saying, time in the market beats timing the market. Timing the market is tough, but from that regular investing approach, at least you can take advantage of when the market does recover. But yeah, beating inflation is number two. And there are at least some good stats to back up that the stock market does beat inflation, which we'll cover in a moment. And number three, create financial independence. So I mentioned we ran a retail investor survey. The results actually all came out today, but these were pretty much the same responses from people. It's about, investing for long-term goals and long-term wealth to try and retire early, et cetera, et cetera. So, with interest rates so low in the bank, people are thinking, well, how can I actually get a better return than 1%, 2%, 3% or whatever a year? So yeah, those would be the reasons, but probably, again, not a massive shock. Why should you invest? Here just goes into a little bit more detail just about how things have increased over a 10-year period. So the NASDAQ is a US market, top 100 sort of tech-related companies in America. And that's gone up 500% in 10 years. Now, look, past performance isn't indicative of future results. This is merely here just to sort of show that the stock market does do well over time and does bring those sort of rewards. And I think on average, I saw a stat the other day that the stock market on average every 10 years at least doubles. So you are getting a nice sort of return there. What can be tricky is, during a period like we're having this year, a lot of individual stocks have come under big pressure. I mean, for example, Facebook, which is still used by it's still the most used social media app in the world. I think 2-point-something billion users. That from its high share price is over like 60, 70, 80% down. Now, individual stocks may never recover, but the stock market will. So we'll talk a little bit about that later on. Trading and investing in individual stocks can sometimes be quite tricky, but that's where diversification can come in. There's a great saying, don't put all your eggs into one basket. And it's the same with investing, really. Don't put all your investments into one thing. I myself learned the hard way, and I said this to people last week. When I first got into investing, I had a friend who was like, you know what? Get involved in this company called Serious Minerals. And I was sold immediately. I didn't even want to know anything about the company. He said it's going to go to this kind of price. I looked where it was trading right now and thinking, hang on, if I invest, a few grand here, I could be retired early. And it was all going so well. And then suddenly the government pulled some sort of funding on it and I lost all that money. And it just so happened at that time, because I was very, very fresh, very, very new to the investing world, it was pretty much all my money that I had invested. Whereas if that was in a diversified portfolio, and it's to say it was 2-3% of my whole account, it's fine. I can swallow that. I can move on. So it's very important when investing, not just to invest in one thing, to spread that risk, because we can never guarantee something will recover, especially individual stocks. A good example of years gone by, I mean, if you alter to get your phones out now, chances are most of them are going to be iPhones, aren't they? But we go back 20 odd years ago and it's all a Nokia, and Nokia had such a big market share and their share price was at record highs, and they really fumbled that. And actually their share price has never recovered from the most recent crashes that it's had. So there is no guarantee individual stocks recover, but we do have the theory to back up that the stock market on average, it does go up each year. Obviously you can get more returns with individual stocks. So that's why some people do go down that route. Stock market versus inflation. So here you can see on the left-hand side, if I can get a little, let's just change let's make it blue. Actually, no, blue is the wrong color. Let's go orange or red. So you can see the orange dots are where inflation has been over the last almost 100 years. And the blue lines that you see there are in where the stock market returns have been. So you get some bad years And actually, we're in line for quite a bad year now, around sort of 16% or so, give or take the day that you look at. But we've also had quite a few good years, and obviously a lot more years to the upside. And the good news is that on average, the stock market, as I said, is about that sort of 10%. And then inflation is only is about sort of 2.8% a year on average. So the stock market does beat inflation, which is good for us to know. And even in times where the market does struggle for a period of time, you at least know with time on your side, we're going to be okay in the long run. But trying to time things perfectly, it is hard. And like I said, some of the smartest minds in the world get it wrong. So if you cast your mind back to March 2020, when the pandemic, I think we were just going into lockdowns in the UK, and you had the top analysts at all these different investment banks and hedge funds that were saying the market is going to crash even more. The market the next day went higher and higher and higher, and never looked back. And it's now 100% higher than that. So trying to time it is tough. We need to understand that. But yeah, these are just the last sort of few year returns, which has obviously been great for investors, right? 28% in 2019, 2020, despite the very, very bad beginning of the year, up 16, a good year last year. And we're almost back down quite a bit this year, but still a little bit of the year remaining. But yeah, that important point is the stats are on our side with the stock market, despite this year being tough. Let's move on. I'm keeping an eye just in case there are any questions as well. What can you invest in? We've sort of gone through this: equities, crypto, commodities, ETFs, all of that kind of thing. You can sort of invest in. Now, some are going to be more risky than others. So if you think about what asset classes are more risky, the higher the risk, the higher the potential for the reward. So generally speaking, it's a massive generalization. A younger person who has no or less bills, less dependents, are more and maybe more time to invest, are maybe a little bit more happy at the beginning of their investing career to take more of a risk, to try and get those big returns in a diversified portfolio as well. But when someone is, say, closer to retirement or close to the period where they want to take money out, they're not as likely to invest in riskier products. So myself, I'm 31 years old, or 32. I think I'm 31. And my sort of portfolio is, it sort of changes every now and then, but I'd say on average, I'm about sort of 10% invested in crypto, well, in my whole portfolio. Now, maybe it should be a little bit higher because I'm still young, I guess. But if I was, we're going to retire in 5 years, that 10% probably be more like 5%. So I'm not looking to take as much of a risk there. But yeah, different asset classes that people can invest in. You can see here: equities, crypto, commodities, and so on. And there are some, people out there that are massively clued up and thought, beginning of the year, commodities generally do quite well as we go into recession. You've got the geopolitical tensions, oil price likely to go higher. Let me buy oil, or let me buy stocks that are in a way correlated to oil price, like ExxonMobil has had a fantastic year. When the market's really struggled, you've got energy companies that have done very well. So you can see how people can be more reactive and proactive in investing in those individual stocks. But it does need time. It does need a little bit of experience as well. Bonds. So bonds well, in most parts of the world, developed countries, generally speaking, are less risky. Maybe not so much in the UK at the moment, but US government bonds, are something where people would have a part of their portfolio dedicated to that as well. Not too much of a risk and not too much of a reward, but sort of constant. Cash as well. We're actually seeing a lot of people at the moment leave their money in cash, almost trying to time and wait for a reversal in the market. The pro of that is that if markets keep going lower and you time it well, you're going to buy lower down, which means better returns. The con is trying to time the market is tough. It really is tough. And it might be you keep waiting and waiting as it rises higher, even though you think it's going to go down. And by the time you get back in, you've got a worse price. So look, the way that I like to do things is I have my portfolio and I look to get in every single month. So rather than say, let's just say someone came up to me, okay, Sam, I've got £10,000 that I want to invest, which would be nice, wouldn't it? You know, to have £10,000. But rather than say investing £10,000 today, what I would do, I would say, what's the date? This is 12th of October. I'd say 12th of October, I'm going to do 1,000. 11th of November, another one. And just, you know, I'm not looking to time the market. I don't care where price is trading. I'm just going to regularly invest. I'm not going to try time things, but I want to be involved for that. When markets do recover, I'm going to be in. Remember, time in the market is better than timing, or is easier than timing the market. Beats it. Now, look, if you're lucky enough or a bit of a genius and you time the exact low, hats off to you. Amazing. But it's hard to do. And you want to make investing boring, repetitive, autonomous, and just have that process where you just keep doing it and keep doing it. Because at the end of the day, if it all goes well, making money isn't going to be boring, is it? But yeah, loads of different asset classes that people can invest in. And generally speaking, I quite like to have a little bit of everything to diversify as well, which we'll probably say another 100 times over the next 30 minutes, just how important it is. For newer investors that want to maybe be a bit more proactive, but don't really know where to start, we at eToro, we talk about, well, think about, you know, to get the sort of the investing brain juices flowing. We say, well, invest in what you know, in what you use and what you love. So when I go to the universities, I say to them, you know, what do you think is going to be popular in 10, 15, 20 years? You know, if you look out your window now, what kind of cars are you seeing more of? And people say Tesla, electric vehicles. And then are people still going to be wearing Nike trainers? Are people still going to be watching the Disney Channel? Are people, you know, still going to be using booking.com, Airbnb, you know, these kind of things? And that's a way where you can start to think, okay, yeah, that makes sense. Or on the flip side, no, people aren't going to be using that. People won't be eating McDonald's or, you know, using Twitter or eBay, whatever it might be. But this is a way that you can start to think. And actually what you can find is, you know, a lot of people know a lot more about the products that they use and they love than a lot of analysts. So yeah, that could be a sort of a way to think about it if you want to be more proactive in having a section of a portfolio dedicated to individual stocks. So for me, you know, over time, I've got a portfolio of about 20 different stocks, 10 that I would consider sort of, you know, long-term holdings, like your Apples, your Amazons, your Microsofts, your Googles, and then the rest, which are probably a bit more sort of a longer term view that I think, if it goes well, would be a greater reward. However, with that, of course, is the risk that that doesn't happen. But I would never individual stock wise invest more than 5% of my account in one thing. So if, let's just say, all of these companies that you see on the screen here, let's just say that was my portfolio, none of those would have more than 5% of my account, because let's just say I'm in Apple, Amazon, Nike, Etsy. But let's say tomorrow there's a headline that comes out about the CEO that's really, really bad, or, you know, the new Nike shoes are, you know, really awful, have really awful sales or whatever. They may never recover. I can't guarantee that. The Nokia example is a great example of that. Now, chances are a lot of these companies are still going to be massive in 10, 15, 20 years, but I don't want to have too much exposure to one thing. Hopefully that makes a little bit of sense. As I said, you know, I know there'll be people not watching on Zoom right now. Feel free to message me, LinkedIn, any questions that you have. More than happy to go through things. Investment analysis. You always hear the saying, do your own research and all of that, and that is true. But I must stress, you know, you don't need to be a hedge fund analyst or investment banker to know all of the stuff. You know, it's a case of, you know, just having a few stats to back up each decision that you're making. So the stock market's a good place to start. And then if you do want to invest in individual stocks or crypto or commodities, okay, let me research about it. Let me find out a little bit more. And there's loads of really useful information out there. Now, yes, you've got to trust those sources. And coming from eToro, I'm obviously going to say eToro is a great place to go. And there are loads of free guides and blogs and podcasts that we do talking about that. But yeah, there is loads of great information out there and education. And when it comes to the sort of analysis, some people will look to understand the way a chart looks in more detail. Again, takes a little bit more time. So I must stress, this is going to be something that you have to be, more precise about if you really want to make it work. But it's not the be all and end all if this isn't the route that you want to go down, because let's face it, a lot of people do work full time or don't have the time to really get it, to learn too much about investing. And actually, one thing that's quite interesting on eToro is and probably what we're known for by a lot of our clients is something called copy trader, which means you can, with one click of a button, you can sort of easily copy and mirror a portfolio of these, what they're called popular investors. And it's a transparent process. You can see everything they've ever done, all the positions that they hold, their risk score, etc., etc. And some people like to do that. They say, oh, well, look, this person consistently beats the market. Even when the market is lower, they're not as low. And, while past performance isn't indicative of future results, I feel they're going to know more than I am. So you can invest in them. And it might be I invest £500 with someone. And if they make 10%, I've made 10% of my £500 as well. So that's something that people consider too. Diversification. I think this year, I must have said this word 1 million times, but it's so, so important. And I mentioned at the beginning of this webinar that we at eToro we partner football clubs, and in the Premier League, the UK Premier League football, 5 teams. And whenever I go to the teams, because obviously they all know, all their clients are football fans, so they sort of understand this. So hopefully this doesn't go over anyone's head who's not a football fan, but maybe sport people can understand. Is think about, when you have a football team, and my team is Arsenal, and I've had a very, very hard 15 years supporting Arsenal. We've come through a bad period, but a couple of years ago we wanted to improve, and rather than spending all of our transfer money on one player, we decided to diversify, because obviously the risk, if we spent a lot of money on one person, what could happen? They could get injured, or they could not live up to the hype. Whereas if we buy 5-6 players for that same amount, if 1 or 2 don't perform, it's okay, because we've got 4 others. And it's the same with diversification. You can't guarantee anything is going to go up. You can have the stats to back it up, but you can't guarantee it. So you're better off just reducing the exposure to one thing and spreading out that risk. It can really be quite helpful. But yeah, that's essentially what diversification is. It's a good form of risk management, and that can be done by sort of a different asset class. It could be done by a different geography. I mentioned I have 20 stocks in my portfolio, and they're from all over the world. And I also invest in different indexes, so America, Europe, Asia, and the UK, for example. So some are doing worse than others this year, but over the 10 years that I've been investing, I'm still doing very well. And that's not that's not me being a genius. That's just me knowing that 70% of the time those markets will go up. And if you invest every single month, you're going to do okay. You're not going to time it perfectly, but that's fine. You let the stats, and sort of history be on your side. Why and how to diversify. So here are just a few different points. ETFs can be quite useful. Exchange traded funds. They basically track indexes. So for anyone who might be thinking or already does, you might say, well, look, the America, biggest economy in the world, biggest companies as a whole there, fine, let me have a little bit of exposure every single month to the S&P 500, the top 500 companies in America by market cap. Well, there is an exchange traded fund called, well, there's loads of different ones, but you can see here actually. So on eToro, this is the most money worldwide goes into this one here, SPY, the S&P 500 ETF. and you just invest in that every single month, and so on. They're low cost as well, and it's a good way of diversifying, rather than, not that people would, but there's 500 companies essentially in that index, so you're not going to invest in all 500. So by investing in a ETF that tracks an index, you are actually diversifying, which is a good thing to do. But yeah, that's diversification covered there. Next kind of point is how often should someone invest? Because, is it a case of I do it once a year? Is it a case of every 6 months? And ultimately, it is what works for you. And I was speaking with a Premier League footballer. Funnily enough, he's 25 years old. I'm not going to say who they are, out of obviously respect for them. But they realized football is a very short career, and they wanted to get their investments in order. And the Premier League footballers are on very, very good money, so that they're not doing badly. But he realizes, well, one, he could get a long-term injury, I'm sure, and that could ruin it. But he wants to understand a little bit more about investing, and he was of the view, and it's not a bad point. And this is actually kind of what I would agree with, and what I do is every time he gets paid, he wants to put some money away to invest. However, people get paid at different times. So, some people get paid weekly, some is monthly. I actually know some people that get paid semi-annually, which sounds absolutely crazy to me, but it is what it is. So some questions we can sort of ask to help us better understand is, well, how often, do we save? How much do we save from that packet, the pay packet, or whatever it is? What's the interest we earn on those savings? At the moment, it's not much in the bank, so hence why people are investing. What returns are we expecting? What's the end goal? We talked about that at the beginning, and the cost to make new investments. But when it comes to sort of knowing whether you're ready to invest, I always use 3 questions. Number 1 is, do I have an emergency fund? Especially in 2022, you never know what's going to happen. It might be I lose my job. It might be my new flat, the roof gives in, or I need to do some sort of work. Have I got money to deal with that? If the answer is yes, I'm a third of the way there to knowing that I'm ready to start investing. Number 2 is, can I weather the ups and downs of the market? Let's just talk about this millennium. You've got this current market. Should we call it a recession? People think it's going to be one globally. This recession, you've got the pandemic 2020, you've got the Eurozone debt crisis 2011, great financial crisis 2008, dot-com bubble 2000. Each of those years, the market absolutely crashed, and it has recovered. So, there are going to be ups and downs, but long-term things do go up. So can I weather that? Could I, theoretically, for the next 2 years, to see my money, go down? Am I okay with that? If that's yes, okay, I'm another step ready. And number 3 is, can I leave my funds invested for a long term? Because you do need time to let it grow, let it compound as well. So having that patience is key. And if the answer is yes for those, okay, well, look, I'm ready to take that next step now. And then how much do I invest? Well, it might be every time I get paid. And a lot of sort of financial planners or money planners say, anywhere between sort of 10 and 15% of your annual take home pay should be invested. And that's fine. I mean, look, you can do less, you can do more, but it's not a bad way to go. And it's, there are some financial planners that use that sort of, was it 50, 15, 5 rule? 50, I think, is spent on, all your bills and your mortgage and that kind of thing, and you can change those numbers around, because obviously you've got to have some money to enjoy yourself as well, some money that you put away to save in your emergency fund, but then you also have that 15% invested too. And that could be a way that people do it. But yeah, there's definitely questions that can help people know whether they're ready to invest. And also, in terms of when to do it, with sort of when you get paid can be a good way. But from a personal point of view, I get paid from eToro monthly. I invest as soon as I get paid, minimum 15% into the market, into the sort of the ETFs that track the stock markets. And I've just done that every single month for the last 10 years. And I plan to do that for the next 20 years as well. And I just don't care where price is exactly trading, because I do trust that over time, 10, 20, 30, 40 years, the stock market should be a lot higher than where it is now. And if it's not, reason is, it's probably a pretty bad one, and I won't actually care about my investments. Let's talk about compounding. I'm sure quite a lot of us will know about, or at least heard of, the word compound or compound interest. I come from a very privileged background. Actually, I didn't study finance, politics, economics at all things that in theory should help with investing. I've sport background, played football pretty much all my life, and then realized it wasn't for me. And I went to uni, studied sports science, again, realized I didn't want to do that. And I just sort of fell into a trading role. My dad works in finance, hence why I say I got a privileged background in terms of that knowledge that he can give to me. And my mum is, she studied maths and art, but an absolute maths boffin. So she was always talking about the importance of, compounding and all of this. And it really is sort of remarkable. The maths behind compound interest, it still blows my mind. But you can see from a few of these charts just what happens over time. So here, we'll start with the graphic on the right-hand side. So this is saying investing $100 a month, which, look, some people have, some people don't. Some people will think $100, I could do, $1,000. And look, people will do what they can do. Let's just use 100, change the numbers as you please. Starting on the blue line at 25, the red line at 35. And this is actually saying just a 5% annual compound interest rate. Now, we know the US stock market does 10%. So this is actually pretty conservative, right? But this is just showing what starting at 0 for both of those would do, starting at 25 to finish at 65. So initially 40 years, and then what 10 years later would do. So, just getting that 5% every month doing $100, you can see goes to 160,000. Again, not to be sniffed at all, is it? But if that compounding really gets a lot steeper in those last 10 years. Whereas if you do wait 10 years and only do 30, again, $90,000 is great. Of course it is, but it's a lot different to 160,000. So yeah, really sort of big increase over time. And actually, I'm not sure if it's on the next slide here. I added this. This is sometimes I feel a bit, I don't know what the word is really. I feel like this is just ridiculous putting this slide in, but I think it is important to show the power of compounding. And it's like this is what you could win kind of slide. And I feel sometimes it's not the right thing to do, but it's not ridiculous actually, because this is what happens. So let's say we do get that 10% average return, okay? Because it is possible, and you don't need to be, an absolute genius to do so, because we know the stock market on average goes up 10%. So let's say we do get that and we invest for 40 years, okay? And some people will, start later, some people start earlier, some people will invest more when they're later, and that plays catch up, and that's fine. But let's just say we consistently do £200 or dollars, change the currency as you please, a month. So 10% a year, £200 every month for 40 years. So that would turn out to be that we invest £96,000, dollars, euros, whatever, over that time. But look at what that future investment value would be, 1.2 million. Insane. And this is why I always have to check the workings, which I've got for us. So I've invested 96,000 and I'm going to get 1.2 million. That's absolutely insane. And this is why it comes back to having that long-term sort of view on things. Because if in 5 years' time you take your money out, it stops compounding. If you take your money out and you try to time it, it stops compounding and you're not being in the market. So this is why even during periods of downturn like we're seeing now, I'm like, I'm fine. I'm not getting out the market now. I'm getting out in years to come. So every month I'm getting in, and I just feel more comfortable knowing that the stock market does go up more times than it doesn't. And when it goes down, you hear a lot of, people saying, oh, it's a generational opportunity to buy. And, when markets are, really have got a really big negative sentiment, you sometimes think, well, what on earth are you on about? But when they recover, and again, there's no guarantee, but history says they do, then you can see, okay, yeah, that makes sense now. So hopefully the workings aren't actually on there. So I'm just going to find them on a different slide that I've got, because it is really interesting just to see. So bear with me 1 second, just while I find those workings. I think they should be on this slide that I've got on a different screen. Yeah, here we go. Look at this. This is insane. This is actually that breakdown. Start from share. No, don't want to share that. Okay, you'll just have to wait and see on this slide anyway. But you can see year by year. You might have to squint to see it. But you know, invest in that sort of $200 a month there. It starts to add and add and add and add, and then by the time it gets that latter part, it just increases so much. You know, the balance after 10 years is 40,000. You know, and you've invested by that point 24. So it's $16,000 or pounds or euros that you made. Again, you're thinking, oh, it's actually not that much. But for the rest of it, you're not changing what you're doing. And then 10 years later, you're now at 151,000, but you've only invested 48. At 30, 72, and your balance is now 452. 10 years later, you've done that 96 that we talked about, and it's 1.2 million, which is insane, really. You know, the maths behind it. And just quickly on compounding, you know, it's some people it is it is incredible when you think about it. But let's just say you've got £1,000. First year you make 10%, your balance is now 1,100. Next year you make 10%, your now balance would be 10% of 1,100. What would that be? 1,010, so it'd be 1,210. You see how compounding works, and it just builds and builds. But like I said, there will be years where it's lower, so it's on average. But as you saw at the beginning, we've had 3 years before this year of double, well, way over 10% returns. Investment portfolio, you can track obviously your investments here. Just got a slide on eToro and how you can do that. But any other investment platform, you'll be able to do the same thing, where you can see all your investments and so on. And there's plenty of accounts out there where you can regularly invest. You can just set it to recurring investments. You don't have to, worry about it or time it and so on. You do get some people, and I'm a fan of this, and I do this, is they'll invest every month, like a small portion. And when the market does dip, say 10% or 20%, then they get in like a lump sum. So as I mentioned earlier, we did this survey, and a lot of people are sitting in cash. So they try to wait to time the market. When they do feel it's low enough, then they will sort of take advantage of that and get in. And actually we did a community event at eToro's office in Canary Wharf a couple of months ago, and it was just talking about bear markets, which the definition of a bear market is when it's 20% lower from a recent peak. And there are some interesting facts. So I mentioned some people try time the market, and a lot of people actually wait for that 20 or 25% move lower. So here are some stats on that. So obviously watch for 20%, as I said. Stocks on average lose 36% on average in bear markets. So you will get some people that are saying, well, if the stock market goes down 36%, I'm going to lump in, because there's theory behind that's how long they last. Bear markets are normal. The market does move down. We understand that. They're short-lived. They're every 3.6 years. They've been less frequent since World War II. Half of the stock market's best days actually come during bad periods. So that's why, again, it's useful to actually be in the market to take advantage of that. Assuming a 50-year investment horizon, we can expect to live through 14 bear markets. So it's 14 periods where the stock market is 20% lower than a recent peak. However, what follows a bear market is what's known as a bull market. And bull markets, when the market goes higher for 20% lower, higher than a low, they last 3 times as long and go up 4 times as much. So there is theory there to sort of back it up as well. But look, timing the market is very tricky, but there are some stats behind when a low might be, and you can use history to try and to help with that. On eToro, there's a virtual platform. All accounts will have a virtual sort of portfolio that you can play around with. You can practice things and so on. And actually, one thing that I think is really helpful, or it will be really helpful for what I want to do at eToro, is do like a monthly session where I build a fake portfolio, a virtual one, but where we can manage it together. We talk about sort of the emotion behind it, where if there is a bad month, what do we do? Well, you keep consistent, you trust your process. Has anything changed? If not, fine, and you just ride that. And I think it could be quite helpful. So that will be something that we do probably in the new year, like new year, new portfolio kind of thing. I mentioned Copy Trader. Again, I'm not here to sort of sell eToro at all, but if you want to know more, just send me a message on that. But yeah, you can see everything they do. It's transparent. And some people don't have the time to invest, so they want to put their faith in someone else. Key takeaways, just before I see if there are any questions at all from the Zoom crowd. Do your research, understand the different types of investments, and start with a virtual account. You know, I think that's not a bad way for those people that do want to be more proactive. It is important to think longer term, to be patient, and set those clear investment goals. I mean, going in to an investing career with no goals, it can be tricky. It can be tricky. You know, you can have just one goal though, and it can be just to have, you know, as much money as possible for retirement. And that's fine. But yeah, it can be useful to have those goals and actually be, you know, what, no, I mean, I said this last Wednesday, and when I was in school, and loads of people actually knew anyway about SMARTer goals, SMART, so specific, measurable, achievable, realistic, and time, I think it is. So you can use the stats we've talked about today to get a better goal. The stock market on average goes up 10% a year. Okay, let me be realistic. I might not be the best, so I might go for 5% over the next 30 years, investing this much to make that. And that's my goal. And that's how you can keep track of it. So maybe you do need to invest a little bit more one month or the other, or rein it in or whatever. Or after a certain period, you do start to invest more, and you can change that goal. But it's good to have one to keep yourself truthful. Understand that there's going to be risks. This is a great year to see that. Really, really good year to see that. The market doesn't just go up. And actually, I think we've come off a sort of a 10, 11 bull market, where the markets have pretty much just gone up and up and up. The last negative year we had was 2018 as well. So, you know, markets, it's been really, really good for investors over the last 10 years. So this year, it's probably actually been a shock to a few people, but it does happen. And that's important to know. And as I mentioned, what follows a period like this usually, or history says, is actually a prolonged period of upside. Diversification helps so much, and it's never too late to get started, even with small dollar amounts. There's that really cringy saying, isn't there, in sort of finance investing, that if you cut out your takeaway coffee, your $5 coffee or whatever, you're gonna, you know, afford XYZ. But in theory, $5 a day over a month, what's there? Let's just say 20 working days a month, $5, $100. So that's what 20 times $100, right? And you've seen what $100 can do in 30, 40 years. So there is actually some method to that ridiculously cringy statement. But look, guys, if there are any questions, get them in. I've already got a couple here that I can see, so I'm just going to answer those. But yeah, like I said, if anyone that's watching on the virtual platform has questions or wants a copy of the slides, LinkedIn's probably best, or Twitter. My DM thing is open, so I can respond to people there as well. A question here, which I'm sure many people will be wondering. Hello, Sam. Can you open a stocks and shares ISA with eToro? And is it straightforward to invest in crypto, as I really don't know much about crypto? First of all, the stocks and share ISA, I believe, is coming on eToro. That is in the pipeline. I'm not completely sure when, though. And yes, it is straightforward to invest in crypto on eToro. And you know what? It is a bit of a minefield, right? The whole crypto space. It's a new asset. It's scary for people. I mean, myself, I've only been invested in crypto for 4 years, and I've been in the world of finance for, 10 years. So it is new to me. I wanted to make sure that I believed it was going to be here to stay. And to back that up, I was looking at a few things. One, I wanted to see regulation, and we're starting to see more and more of that. Two, I wanted to see institutional adoption. So you've got investment banks getting involved. You've got fashion companies like Gucci getting involved. So if you're anti-crypto, you're almost saying to people, you know more about fashion than Gucci. you know more about finance than JP Morgan, for example. So that for me gave me the confidence. It is a riskier asset. So in 10, 20, 30 years, there are going to be some crypto assets. This is, say, Bitcoin, Ethereum, that may be way, 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 way higher than where we are now. But they also might not be. So again, it comes down to maybe just having a small percentage in your portfolio, or higher if you want to take more of a risk. But yeah, easy to. There are some guides as well about crypto as well. But think of crypto as an asset class. So similar to how you would have, say, stocks. They have a little breakdown from that. There's different types of stocks. There's tech stocks, there's growth stocks, there's defensive stocks, there's dividend paying stocks. In crypto, you've got cryptocurrencies, you've got crypto tokens, and so on. You've got DeFi. There's loads of different subsectors, which again, it does confuse people, right? But just think of it as an asset class as a whole. And if you believe there's going to be growth in that area, then yeah, maybe it's worth a little bit of exposure. But again, trying to time that is going to be tough. Hence why, rather than investing just once, split that up and do regular investing would be my sort of view on that. And that doesn't necessarily mean every month. That could be every quarter or 6 months as well. No question for me. Thanks for sharing. No problem. Oh, I love this question. I'm thinking to make green investments only. So actually, one thing we've done on eToro, and actually you'll see this really starting to pick up across the board, is, and you probably all heard of it as well, sort of ESG investing, which is massive now. People are actually really starting to care about the companies that they are investing in. So, and again, I feel like this is massive, like self promo of eToro, but I do apologize. But we got this ESG score thing, so you can actually see, and you can see if you type it in Google, you'll find it. But you can see on eToro if it's got a green score, a company, you know, they're sort of leading the sector in ESG. Amber, okay, room for improvement. Red, not so good. So you can actually separate those companies by that. And it is an interesting thing. People are caring more and more about it. So yeah, you can absolutely do that. And obviously you can use any platform you want to invest in these related companies. So yeah, I think it's definitely something I would look at in response to that question. I think more investors are caring about it. And if more and more investors do, then I need to as well. Can I please drop my email? Yes, I can. I'll put that in the chat at the end of the session. And I think that is the Zoom questions done now.